Hey, good evening, unit holders and SIAS members. Thank you for taking the time to join us at this dialogue with Stoneweg European REIT, SIRT for short. Today, we are here to hear from the management of SIRT about the proposed stapling of a business trust to the REIT. The EGM will be held on the 29th of April at 4 p.m. at NTUC Centre Room 801, Level 8. Here are some key highlights and pointers that you should be aware of. The manager of SIRT has proposed for the real estate investment trust to be converted into a stapled trust comprising Stoneweg European REIT and Stoneweg European Business Trust. According to the manager, the stapling will help to achieve the following objectives. Firstly, it will create an optimal tax-efficient corporate structure to enhance investor appeal and debt financing options. Second, it balances stable REIT income with business trust growth potential, reducing reliance on passive rental income and improving resilience to market cycles. Today, we have invited the CEO and Executive Director, Mr. Simon Garing from SIRT. So thank you for being here to engage your unit holders. We will kick off the session with an introduction at the CEO. And as this is an online session, you can actually start to key in your questions at any time from now. Without further ado, I'll hand you over to Simon.
Thanks, Mr. Ang, and thanks to SIAS for the opportunity to talk to many of our investors through your great organisation, and to everyone that's dialed in tonight. Thank you very much. I hope you've had an early dinner or a good dinner after this. Just as a brief introduction, our REIT is listed here in Singapore. It owns 105 assets across Europe, predominantly logistics, light industrial, and office buildings, as well as 2 data centres. Roughly about 2.5 billion euros of assets, 86% weighted into Western Europe. And we've got about 850 thereabouts tenants paying very good rent to us. And therefore, that is the basis of the distribution. We're able to invest into Europe through our network of 200 staff in the local markets that speak the local language, that understand the local property markets, tenant markets, municipality, planning, permission, tax, etc. All the things that you would expect our local teams on the ground to be able to do. And that's really been demonstrated over the last 6 or 7 years with maintaining very high level of occupancy. Resilience is a word that gets thrown around a lot. We certainly very focused on resilience in our portfolio construction. Our largest tenant only makes up 4.5%, 4.5% of our income, and our largest building is only around 7% of the total income. So we're very diversified and not relying on any particular industry type or tenant type. And that's, again, provided very good resilience in the income line. Almost all of our assets are freehold. Again, that's a big point of difference for investing into Europe. And another big point of difference is that almost all of our leases, which tend to be 5 to 15 years in length, which is much longer than here in Singapore, all of the leases, or almost all of the leases, have annual inflation increases. So even if the markets are fairly constant, we're still able to drive net property income growth through the inflation mechanism. Over the last few years, with the rise of interest rates, clearly many of the REITs, including ours, have been selling assets to ensure that our LTV, our gearing, stays within the MAS covenants, stays within our own banking and bond facility covenants. And to make the point, our board has an even more conservative gearing policy than all of those covenants. So we've been able to sell almost 300 million euros of assets in the last couple of years to ensure that in a rising interest rate environment, we didn't see our LTV or our gearing increase, and therefore we had not needed to be a desperate seller or indeed raise expensive equity or indeed cut our distributions. So we've had a 7-year history of uninterrupted distributions. We're currently paying out 100% of our distributions. I should say that those asset sales have all been above valuation. And as part of the recent volatility in the market, our board was very confident based on the very strong lease to expiry. We have now over 5 years of visibility of our income, and our recent bond issue where we refinanced our 2025 bond out for another 6 years. The board was comfortable to actually send a signal to the market and commenced buying stock back, our own units back, in March. And so that is one of the resolutions at the AGM being held at the same time as the EGM next week, is to ask unit holders again for our annual buyback mandate, as well as the other requisite resolutions that every trust has at the AGM. But in our case, we're in very good shape, and to send that signal of the board's confidence in our investment proposition, they felt that the 35% discount that the REIT was trading at, or the 9% dividend yield that the REIT is trading at, that in itself made a very good investment proposition, and hopefully sends a signal to you, the investor, of the confidence that the board has, notwithstanding the volatility in the broader market brought about by geopolitics and the potential tariff wars and all of the uncertainty around US interest rates and US dollar. We actually see medium term this current tensions, political tensions, actually bring Europe together and actually start to see positive investment momentum in Europe, and galvanize Europe together. And as owners of warehouses in particular, we're seeing that not just through the well-known tailwind of the e-commerce, we're also picking up the benefits of the onshoring and the bringing back into Europe many of the previously outsourced supply chains. So with that, Mr. Ng, thank you again for your time tonight, and I look forward to a healthy discussion.
Thank you for the presentation, Simon. As unit holders are aware, Icona Capital and Stoneweg have acquired the manager of the trust, formerly known as Cromwell European REIT, along with 27.79% strategic stake in the REIT and the property manager. With this, Stoneweg has effectively assumed control and strategic direction of the platform. So perhaps I can start with the first question. Could you clarify the strategic intent behind the stapled trust structure? Specifically, is this intended to support activities beyond the typical scope of a REIT, such as development projects, investments in non-income producing assets, or adjustments to leverage and distribution frameworks?
Yeah, thanks, Mr. Ng. There's a couple of questions obviously in there. Can I just deal with the first one? Obviously, Stoneweg, as a Geneva headquartered alternate investment management platform, now has about 11 billion euros of assets under management. It also manages another REIT-like structure in Switzerland. So it's quite used to the governance that's required to run REITs such as ours. They spent a long time doing their due diligence on the REIT and invested 280 million in buying both those stakes that you just mentioned. And we can talk more about that as the evening progresses. And where, as you can see with the logo behind me, the integration into Stoneweg as the owner of the management company is now largely behind us. But I would like to draw a distinction then between what happened with Stoneweg to now the second part of your question, which is around the proposal to create a stapled trust. We have an independent board. The directors have not changed from an independent perspective. We've got Stoneweg have appointed 2 nominees onto the board, a board of 6, replacing the 2 Cromwell appointed directors. So we still have the majority of independent directors responsible ultimately for the strategy and the governance of the REIT. So I just wanted to make that distinction. In terms of the benefits of the proposal, the first is very much tax efficiency. So our distribution last year of 14 cents, remember, stocks trading at around €1.40. So, we paid almost a 10% yield out last year. That's after we already pay around 10% tax in Europe. So the Singapore REITs that have just local Singapore income are clearly a tax transparent vehicle. But many of the offshore REITs, like our REIT, like Stoneweg European REIT, we already pay taxes, income tax, withholding tax in our jurisdictions throughout Europe. So the primary rationale for creating the business trust is to provide a more tax efficient structure. Let me give you some clear examples. The first is in Germany. Germany has a specific structure that is more efficient if 89.9% of an asset is owned by the REIT and 10.1% owned by the business trust. Don't want to necessarily go into the whys and hows of that, but that will save the REIT longer term capital gains tax, REIT transfer tax, and also they look through to the trustee, perpetual trustee, Asia in our case, and they also looked at if that vehicle, if the trustee was to change ownership, then that may trigger tax. But in the proposed structure, we wouldn't be caught up in that. Let me give you a second example of the regimes that we're dealing with. So in the Netherlands, we have a major project which is very close to getting the final approvals in Amsterdam. To encourage building in the Netherlands, they recently introduced a tax advantage to say, if you build this building and sell it within 6 months of completion, we will give you a substantial incentive. And in our case, that's about 15 million euros. So that's a lot of incentive from the Dutch government to undertake that. But as that asset is currently held in the REIT in Singapore, then the Singapore REIT rules say that we can't develop to sell. We need to develop to own for 3 years. But if that asset was to be transferred into the business trust, then we're able to take advantage of those Dutch incentives. The investors still own that asset as part of the stapling proposal. There'll be one REIT unit, one trust unit, and one business trust unit stapled together. So you will own exactly the same amount of the asset. We will just have more options within many of our assets on what we can do. There's another example in Rome, an existing asset that you, the unit holder, own a part of, that a particular government department wants actually to have us provide a turnkey development project. So they're prepared to pay an amount up front for us to build the asset, which we were going to do anyway, and sell it to them on completion. Again, that is something that in the business trust we can take advantage of and potentially provide quite a substantial profit. I should highlight that the last part of your question, we are not changing our investment strategy. This is not about us going out and doing things that we're currently not doing in terms of our strategy to be predominantly logistics, light industrial, complementary assets such as data centers and office buildings. We're not looking to increase our gearing. We're not looking to change our distribution policy. And finally, there's no change in fees. So the manager, Stoneweg, is not making any additional fees in doing this. Our intent of providing this opportunity for investors to vote for the stapling is not about changing the fee structure. It's not about changing the distribution profile or undertaking substantially more risk or moving away from our core competency, which is logistics, light industrial, office and data centers.
Hey, thank you. That's really clarify things. Before I move to the second question, I'd like to tell all the participants here today, and there are many investors here, please start, typing questions. It shouldn't be just me asking questions. So it's for you. It's really meant for all of you. So, please ask him difficult questions. Okay, so while they're doing that, perhaps I'll move on to another question that I have. The current topic here in Singapore is the internalization of REIT managers, and there's always, a discussion about whether managers should be internalized or they should be external. So is there a longer term plan to consider internalizing the trustee manager, potentially through unit holder ownership? There is a school of thought that internalizing the trustee manager achieves a higher level of alignment of interests with unit holders, and internal ownership enhances governance and achieves cost efficiency. So perhaps you have a view on that?
Yes, thank you. So a couple of parts of the question. So very simply, the first part is no. There is no long-term plan to a pathway to internalisation. So while this process may allow for that, it's certainly not in our planning. That would be a byproduct. In terms of the question around governance, prior to my appointment as the CEO of the REIT, I was previously responsible for global research at Merrill Lynch for real estate, and prior to that also at UBS. And even back then I was making the case that well-governed externally managed REITs are no different to well-governed internally managed REITs. One of the reasons we've listed in Singapore is the governance framework here, particularly the disclosure regime, very transparent, and we've won a number of awards and get recognised for our transparency. Our recently published annual report will provide you with my KPIs and my team's KPIs, and you will see there that we are very aligned to enhance the distribution and to drive value through the share price. There is no KPI, there is no incentive for me just to go out, or the team or the board to go out and just grow AUM, which I think is the inference in your question. We're about delivering risk-adjusted returns to the investors. And I'm an investor in the REIT, and I will do what I can and have been doing what I can, as well as what the board oversees and my team help me with, is driving value for all unit holders. This is not about a money grab for the manager. And if I can make the point that while we were owned and sponsored by Cromwell Group Australia, their accounts are public as well as a listed company in Australia. So it's very easy to open up the annual report in the last 7 years to see that Cromwell Group did not make a substantial profit from managing these assets. We are in 10 countries in Europe, and it was making less than $1 million in profit. So this notion of if you internalize, you can create these extra profits, simply in our case is not true. As an example, we have 69 finance staff throughout Europe, in Poland, in the Nordics, in Germany, dealing with the local languages, dealing with the local taxes. And really there's not significant savings between internal and external. And then I think you also miss the pipeline opportunity. If you're internally managed, we now have a sponsor in Stoneweg that is very experienced in Europe as a developer and owner and manager of assets. CERT has a ROFA over the pipeline within Stoneweg's wide network and portfolios, and therefore we have opportunities down the track to look through their portfolio and see what would make sense at the right time for the REIT. An internally managed REIT would not have that opportunity.
Thank you for that answer. I'd like to go back because we have a couple of questions about the stapling the units. One attendee has asked if this new stapled trust structure allows Stoneweg to develop properties. I know you mentioned something about sticking to what you've already been doing. But so the question is whether you have a track record in this area of property development and opportunities, and are there any other kind of risks associated with this new trust structure that few shareholders should take note of?
Yeah, that's a good question. So one of the advantages of our team is that we have development managers in each of our countries. We have project managers who can look after asset enhancement initiatives, as well as for larger projects. I'd point to last year when we completed our first substantial, for the REIT anyway, first substantial refurbishment and asset upgrade in Milan, a property called Nevesa. That was leased 100% on completion of the project. We were able to deliver almost a 7% yield on cost and deliver a development profit to investors. The anchor tenant there is the Universal Music Group with their Italian headquarters in that building, and it's attracted many other notable tenants. So that's one example within the REIT of quite substantial projects. And I should add, as part of our investment strategy, we know that office tenants in Europe are looking for green buildings for energy efficiency and staff amenity. That building in Milan that we've just completed is now certified as the second most energy efficient office building in all of Italy, and quite highly ranked throughout Europe as well. Our organisation has been developing assets for almost 40 years. So while the REIT has only been here for 7 years, the basis of the old Cromwell business, now the Stoneweg business, has been around for a long time. And in fact, it was previously called the value add business because that is what we did. We would take assets, we would refurbish them successfully and reposition them. And that's a strategy that we've been doing over the last few years. This is to provide extra growth than just collecting the rent. And we do this in a risk measured way. So at the moment, we are seeking a pre-lease in one of our other projects. And the board has decided that we want to make sure that we get a good pre-lease, good tenant signed before we do it. We've also had a very good track record in developing logistics and light industrial properties throughout Europe. We've recently completed a number of prime assets in both Czech Republic and Slovakia. And we are currently working on a number of major asset enhancement initiatives. You just check our last annual report or our February 2024 results to see the pipeline of assets that we have. Just to name a couple of them, we have a 60 million euro project in Haagspoort to upgrade that building to one of the most energy efficient buildings in the Netherlands. We also have a major project in Amsterdam, which is in the prime part of that city. And then we have our jewel in the crown called Parc de Dock. This is a 10-hectare, quite old collection of warehouses in the middle of Paris. It's currently very much last mile logistics, and we've been going through the permitting phase within the municipality there for the last 3 or 4 years. I should point out, Mr. Ung, that we've been talking about these projects for a little while now. This is not just new because of the stapling, but what the creation of the business trust does is it creates slightly more opportunity on these sites to deliver higher profits for investors. So we're not going out and buying more of these sites. We want to deliver what we currently have. If we were to do all of those office reconversion projects, for example, at one time, we wouldn't do that. But if we did, it would only be 12% of the total value of the portfolio. So this is not something that investors are going to wake up one day and see that all of a sudden we're doing all of our projects at once. The other thing to help on the second part of the question is we understand that change sometimes creates nervousness, sometimes creates questions. What we've tried to do is ring fence the size of the business trust. So we stated in the circular that in the distribution of the business trust, it's only 15 million euros. So what does that mean? So currently the REIT has an NAV of 2.03 euros. That's the NAV, the net asset value per unit. Post the stapling, the REIT will have a NAV of 2.00, and the BT will have an NAV of only 0.03. So you can see that from an equity perspective, the investments will still be substantially, over 96, 97% in the REIT. We're not moving all of the assets into the business trust. We're not moving the debt into the business trust. It really is only at the margin. It really is incremental. And like I said at the outset, it's really being done primarily for some of these tax efficiencies, given that we do pay a substantial amount of tax, and tax laws are changing all the time. The structure that we came to the market with in 2017 was right for the time back then. And as we know, there's more complexity in this world, and this is what's a large part of the timing as to why now are we doing or making this recommendation to investors for next week. This is not to create a substantial amount of new risks or business opportunities that we're not confident ourselves in doing. The board is not changing development limits, it's not changing gearing limits, and it's not changing the distribution policy. Maybe if I can give you another example. As we all know, Europe is running a very heavy energy renewables program, and in fact 35% of our electricity throughout our portfolio is already sourced from solar power or wind or other low carbon emission sources. So when we put solar panels on our rooftops, the tenant may or may not decide to take that electricity. We then have the option in many countries to sell that electricity back into the grid. And there are programs around, many of you will be familiar with, where you're selling that electricity on the hourly basis. Now, if you do that in a significant enough size, we've got 1.7 million square meters of NLA. It's 17 million square feet. That's a lot of space. That's a lot of rooftops. If we start generating a lot of this electricity and we start trading it, well, technically under the Singapore REIT regime, that's not considered a real estate business. Yet all of the people listening in would say, okay, well, if you're generating that electricity because we all want to put solar panels on our rooftop, surely you should be able to make some revenue from that if the particular tenant doesn't want to take it directly. So those solar panels can then sit within the business trust, and we're not going to get into trouble by the Singapore regime by having solar panels, which almost everyone is now putting on their buildings. And it's something that a lot of the tenants are requesting. But then in a multi-let business park or logistics park, not every tenant will want to take that electricity. So what do we do with that extra power? We'd like to sell it. And the more we do, the better unit holders will be. But we just need to make sure we don't get into trouble under the Singapore regime.
Yes, thank you. I think that explains a few of the users of this business trust structure. There are a few questions surrounding distribution, and you alluded earlier that there's no change in policy, but perhaps you can comment a bit about how does this new structure, will it affect the distribution of 90% of the income? Will it still adhere to that Singapore's dividend and tax policies? And you mentioned yes, I think. But perhaps you can clarify that. And also you mentioned about tax savings. And does that also mean that distributions can be increased?
That would be providing a forecast, which I unfortunately can't do. But I can answer the first part of the question, and that is no, the board is not changing its distribution policy as a result of this. And again, I make the point that only 3 cents out of $2.03 will be in the business trust. So even if that was to change down the track and the business trust didn't adopt the same payout ratio as the REIT, it's on a very small amount anyway. So the answer is no, we're not going to change the policy. But again, you can look at how small the business trust is. It wouldn't make much of a difference anyway. I do, just for the full sake of transparency. So this 90% rule that people refer to is actually based on Singapore, on IRAS, on the tax regime that says your REIT can retain a tax-free status if you distribute 90% of locally sourced income. So then you may ask, why have some of the US REITs gone to a zero payout ratio? It's because their income is actually not locally sourced. So this is why I made the comment in my opening remarks that in the last 7 years, we have paid a consistent dividend. We did not have to cut our dividend because of gearing issues or anything like that. But for full transparency, that 90% IRAS rule for Singapore REITs only refers to locally sourced income. Again, that's not to detract from the question. The question, we will continue to pay that high level of distribution as we've been doing. I should also say that when we compare ourselves to many other REITs, we are very mindful of the concept of our gearing levels, and we have an investment credit grade rating, which many other REITs don't have, because we tap the public bond markets. So while we're managing the risks on equity, we are also managing the risks on the credit side. And I can tell you the credit investors and the credit rating agencies, particularly the two that cover us, Fitch and S&P, again, that is a very public way for you and SIAS and investors to understand their view on the risk of what we're doing. And both organizations, Fitch and S&P, have not changed their outlook and have not changed their ratings on the REIT, because they see, like as I've described to you tonight, that this is really a change for the better than any substantial increase in risk. And so our credit continues to be well bid. As I said, we did a bond earlier on this year. It was 5 times covered. We only wanted to raise 500 million euros. At one point, we had almost 3 billion in the book. And in spite of everything that's been going on with Trump and politics, etc., Our bond in the secondary market in Luxembourg is trading above the issue price back in January. So even with this announcement of stapling a few weeks ago, and since the documentation has been out, the circular has been out, bond investors who are typically the canary in the coal mine are very comfortable with what we're doing. They don't see an increase in risk. And in fact, they see a reduction in risk on the basis of what we're saying around the tax structuring.
Well, thank you. That's very encouraging, actually. Perhaps I can move on to the portfolio. How does the new sponsor evaluate the quality and long-term potential of the portfolio it acquired? And what is the expected pace of the strategic pivot towards logistics and light industrial assets? There's also a related question about whether you have non-strategic assets, and are you actively trying to divest them? And do you think you can still get a premium for them?
Sure. Let's take it as two different parts there. So firstly, Stoneweg, and it's quite an insightful comments in your question. So firstly, Stoneweg spent a good 6 months doing due diligence on the existing portfolio. They spent millions of euros on due diligence. They got each asset individually valued by an independent valuer. They got an engineering company to go through the top 28 assets. They had access to 32,000 documents in the due diligence room. So first and foremost, they were very driven to invest into the REIT at 1.51 per unit. They really believe that the gap of the share price to the underlying value of the existing assets was material, and that in itself was a primary reason for the investment. But in your question, you talked about future value, and this comes down to the pipeline of asset enhancement initiatives that we've been working on for the last few years that have only just started to come to fruition. We've completed 3 projects in our portfolio in the last 12 months, but we have others set to now start. So we've been quite public about these AEIs. There's about 250 to 300 million euros in near-term projects, and park to dock could be something larger, albeit that will take a longer period of time. So it was certainly the here and now, the valuation gap was appealing, and then the ability to see us as a REIT deliver more growth through our existing assets, just taking older office buildings, reconverting them, taking greenfield land next to a warehouse and expanding the warehouse. An example is Hella. Everyone knows the lighting company that makes the headlights for the cars in Europe, HELLA. They need more space, so we have more space next to our warehouse. We build that for them. So certainly Stoneweg were attracted to the longer term growth potential within the existing portfolio. The second part of the question was what, Mr. Ang? Just remind me, please.
It was about divestments of
yes, divestments. Yep, of non-core. Yep. So as I mentioned in the pre-prepared remarks, we've divested around 280 million euros at a premium, around a 10% premium to the valuation. So we have a track record of doing that. Now, we were driven a few years ago when inflation was over 10%, and it was clear that the reserve banks around the world were going to ratchet up interest rates very quickly. So we commenced selling assets in 2022. Now, as you de-lever, then that has an impact on the dividend. Just like when you buy an asset, that increases dividend. When you sell an asset, it has the opposite effect. And so the slight decline in our dividend over the last 3 years has been as a result of the decision to sell assets to ensure that our balance sheet remains in good shape, as well as to offset the rise in interest rates. So they're the 2 key reasons. We said last year when the ECB started cutting rates before all of the other central banks, that we would see European values stabilize. And in fact, that's what's happened. In our last results. We showed that our logistic assets actually started to go up in value after the last couple of years in the down cycle. We think we're now in a stable to an up cycle in real estate values. And this is why a lot of investors are pouring capital into Europe. It's both in the stock market and starting to happen in the real estate market because of the benefits of the ECB cutting rates, as well as some of the other benefits going on in the world at the moment that's driving investors into Europe. So we're largely through that phase of needing to sell or wanting to sell to provide that confidence to investors that our gearing was stable. Now, as we look to sell assets, it will be more opportunistic. It will be as a result of someone putting a price on the table that we think is very attractive for us, and the fact that we have these other alternative investment opportunities within our existing portfolio that we would like to fund. Clearly at $1.43 per unit in euros or 212 in Singapore dollars, at a 30 to 35% discount to NAV and a 9% yield, that's quite difficult to raise equity at these prices to make a accretive to dividend acquisition or development. So we are recycling assets through that sale program into these development opportunities. So if we can sell an asset on a 5% yield and we can reinvest it into a project on a 7% yield, that will grow dividends, and that will provide a more modern and more long-term sustainable portfolio. So we're looking to future-proof our properties. Can I give you an example that 80% of our office assets are BREEAM certified? So that means that we have a certifier coming along and saying these assets comply with the energy efficiency, with the amenities, with the modern standards. 5 years ago, we had 0. So we've gone from 0 to 80%, 80. Now, across the whole of Europe, only 20% of office assets are BREEAM certified. Yet 50% of all tenants in the market are looking for these BREEAM certified assets. So if we have an older building that is well located, we have two options. We can sell it, or we can do the asset enhancement ourselves and benefit from the large step up in rents. So in most of the office markets that we operate, we're looking at office vacancies in prime A-grade buildings at less than 4%. Let me say that again. The grade A vacancy in the key markets that CERT invests, like Milan, like Amsterdam, like The Hague, vacancy is less than 5%. That's not the 20s and 30s in other continents. So what we're saying is there is a shortage in Europe of modern, well-equipped, energy-efficient office buildings, and we are in that process of converting some of our assets. Now, for those assets that we believe are in the wrong location, let me take an example. Pre-COVID, business parks were popular because they were cheap. They were out of town, low rent, so that small businesses, medium businesses, large businesses could move out of the big cities, out into the suburbs where people could drive, but there was no amenity. There's no coffee shops, no laundromats. It didn't matter. It was just the low price solution. Post-COVID, and with the work from home trend, and now we're seeing that reverse, it's because business parks aren't as popular as they once were from employees and employers, and tenants are moving back into strong locations and are prepared to pay a higher rent because they see greater productivity by bringing their employees back in. So as we've been able to convert these older but well-located office buildings, we've been able to generate between 40 and 60% higher rents. So when you think of upgrading an office building, there is actually a good return in Europe. There is a profitable reason for doing that. Now, that's not our key investment strategy. Our key investment strategy is logistics, light industrial, and data centers. But we still have a portfolio of roughly 40% of our portfolio is in office. We're not just going to tip that all out when we can make substantial profit for investors by transferring and upgrading those buildings. And bringing it back to the proposal for stapling, some of those buildings in certain countries are better to be upgraded, owned by the BT than owned by the REIT. So you as the investor, you will still own that building, because when you buy the REIT on the market post-stapling, you will have a unit in the REIT and a unit in the business trust. It's just that the one building may be moved out of the REIT and moved into the business trust.
Okay, thank you. I think that was quite a good answer, and more use for the business trust as well. You mentioned something about interest rates having falling recently. Do you have any view on the trend of the interest rates? I know in Singapore, also recently our treasury bill rates has been coming down with each tender. So do you have any views on the European interest rates?
Sure. So as I just mentioned then, ECB cut rates in June last year. They were very close to 4%, now down to less than 2.25%. Inflation is effectively down at the target of 2%. So the market is pricing in further rate cuts. And in fact, 1.5 to 1.8% is the current implied 12-month Euribor rate. The recent slowdown in the economies, partly through the geopolitical and the tariff wars and the creation of uncertainty, we think that's only going to encourage both fiscal stimulus and monetary policy stimulus throughout Europe. An example of that is in Germany. We've all read here in Singapore, the new German government, only within weeks of being elected, and even before it's taken office, moved to remove the German debt handbrake, and so has allowed 1 trillion euros to be raised under German Bund issuance to invest half into infrastructure and half into military defense. And that has come at a time that is actually quite relevant for us. Let me tell you why. So last year, everyone was concerned about VW and the German internal combustion engine car manufacturers closing down plants and letting 10,000 workers go. It hasn't happened in 60 years that VW was going to let these people go. What has happened since the new administration in the US is that the military defense have decided and have been talking to VW about taking on those factories and retooling them. So, you know, I don't want to make fun of the situation, but, you know, some people thought VW built tanks. They now are going to be building tanks through Rheinmetall, which is another listed German company. So that is fortuitous for us, having, you know, 5 or 6% exposure through our own tenants, having exposure to that type of manufacturing. They now have a new customer, and it's called the German government, now prepared to borrow to invest in their defense. And in my prepared remarks, I talked about the drive of e-commerce. We've known about this for, you know, since COVID, that Europeans, like many of us here in Asia, you know, like going down to the wet markets, like local shopping, have had to move towards more e-commerce. It's now about, depending on which country, 7 to 15% of their total retail sales now is e-commerce. So that's a big driver of logistics, and some of our big tenants like DHL, UPS, FedEx are doing great business. But now the next tailwind for our logistics and light industrial portfolio is this onshoring, this bringing back supply chains. And you know, let me give you another example. At the end of 2023, the European government passed what's known as the EU Chips Act. And at the time, you recall, post the Suez Canal being blocked post COVID, that many manufacturers in Europe couldn't get access to semiconductors, couldn't get access to chips. and Europe was only producing 9% of the world's semiconductors. That act has opened up 40 billion euros of a war chest to see Europe becoming 20% of the global chip production by 2030. That's not that far away. One of our own tenants is actually ASML in the Netherlands. Many of you will know, one of the largest European companies, big R&D business in semiconductor factories, etc. Their business is looking very good. They're taking a lot more space from us, and as you create these new industries, that creates more demand for supply chains, which creates more demand for warehouse space. On the back of that, just that European Chips Act, Savills in their research report estimated that act alone would create demand for 10 million square meters of warehouse space, just from one industry. I could talk about solar panel industry. I could talk about a number of industries that we will see. I'm not saying in the next 6 months. Clearly, there's uncertainty in the next 6 months. So please don't take my bullish comments around, are we going to see a takeoff in GDP in Europe in the next 6 months? No, that's clearly not going to happen. But over the medium term, and investing in real estate is about the medium and long term, this, I think, is very beneficial for Europe. And that comes back to your original question around interest rates, is that in the short to medium term, we are very confident in lower rates, and therefore what that means for valuation of real estate and valuation for stock markets. Many of you will follow the decline in the US stock market this year and the move into other markets, including Europe, and in part it's as a result of movement in interest rates.
Thank you. It looks very interesting. I think there's a potentially, if it's a falling interest rate environment, we could see better markets, and you detailed out some potential growth areas in the industry in Europe as well. I will just ask for any last questions from attendees here today. I see almost all of you have stayed throughout, so thank you for that. Hope that was very fulfilling. So I will just go ahead and ask one more question, and while any other last questions come in from the audience. I read this thing about the right of first refusal. Could you perhaps share what that means for properties, and how does it align with the overall strategic direction of the REIT?
So before Stoneweg acquired their 28% stake in the REIT and the management team in Europe, they already had a logistics and light industrial development and investment portfolio, and they have a very substantial data center development portfolio as well. So in the last few months, having only just become Stoneweg, my team and I have been going through their shelves to see what do they have in their cupboards. And this is very much an approach from us to Stoneweg. So this is us as the REIT manager, us with our independent directors saying, you now have a ROFR, you now have access to acquire into the Stoneweg pipeline and their own portfolios that they manage, either for their own money or for other clients that they manage for. So we are working diligently through what is quite an exciting bunch of portfolios, and we are looking at ways of bringing the benefits from those portfolios into the REIT. Again, there's nothing to announce today or tomorrow, but it's a case of there's some very smart, well-credentialed, financially acumen staff management team within Stoneweg, and we're really excited to be able to partner with them and to work with them shoulder to shoulder to see where in their networks, where within their own portfolios, could we find good nuggets of value for our investors here. To your governance point, I should just point out that in Switzerland, they're not allowed to do IPT. So, one of the benefits for Singapore investors is the new sponsor is Swiss, right? Their governance, I think of Switzerland as the big brother to Singapore in many ways. And the whole management team of Stoneweg is like, when they were out here in Europe, in Singapore, we saw 150 to 200 investors. And this was a typical question. What's your pipeline? What are you going to inject into the REIT? And this expression, inject into the REIT, goes back to your first question around governance, was like, guys, we can't inject into the REIT. This is not allowed in Singapore. You have to ask for it. We can't do it in Switzerland. So they were actually surprised that in Singapore, investors see a pipeline as something positive. They're coming from a position where it's not even allowed. It doesn't matter about getting two valuers or all the full transparency that we have in Singapore about it. It's just not allowed in Switzerland. So, if down the track we were to make a related party or interested party transaction, it's coming from us. It's not an injection from this new sponsor. It's driven by the management team and the board of the REIT saying that makes sense for us. That's good on a risk-adjusted basis return. We think this will help drive the share price. This pivot to logistics is because logistic REITs and industrial REITs with data centers trade at or above NAV. Office REITs require more capital. In Europe, we can make a return out of an office building, but maybe not as much as we can out of the other asset classes. So our pivot ultimately to logistics, light industrial and data centers, which we've been on since the last 3 or 4 years, is about closing the gap to NAV. We can see that in the REITs that have this asset class. And so that's big picture, that's our main strategy, is move into these assets that investors are prepared to pay, listed REIT like ours, a higher price, because they see the growth, they see the cash flows, and they see the opportunities. And that's what we've been trying to do. And with Stoneweg now, we think we can accelerate that pivot. They have deep pockets. One of the major shareholders of Stoneweg is one of the larger private banks of Switzerland. They have a great network of investors. I'm already starting to talk to many of them. So, we're looking ultimately for more investors within the REIT. That's ultimately what drives the share price, without being glib, more buyers than sellers. So, if we can access not just our community of investors and relationships, but we can bring more into the REIT, that's only going to benefit you as the investor here on this line, if we can generate more interest globally. I am proud that 10% of our investors are actually based already in Europe. So they look at us in Singapore and they say, we actually like what you're doing. We know you're not listed in Europe. There's no leakage on a dividend between Singapore and Europe. So we're happy to invest in you while you're listed in Singapore. So, I know it wasn't one of your questions, but we have been asked before, is this a precursor to relisting in Europe? Because we now have a European sponsor. That's not the case. We have a majority of our investors are based here in Singapore and Asia, and that's where we really want to be.
So while you're on that, perhaps I could ask you, why do you like the Singapore market here?
Well, my wife is Singaporean, so that's the start. No, we chose to list here because of the growth of the financial services market. We know that REITs provide a yield component for investors' portfolios. You can't put all of your money in NVIDIA. You need to have a balanced portfolio. Equally, you can't put all of or you shouldn't put all of your investment dollars into one currency. So we know the Singapore dollar is reasonably correlated to the US dollar. And we know that a lot of the trade and services is tied to China. Yet Europe, as and equal in the size of the economy, 18, 19 trillion dollars. It's up there with China and the US as an economic powerhouse. There's very few opportunities for Asian Singapore investors to have exposure. We are still the largest REIT IPO in the last 10 years here. We know that the euro rises and falls. We know that, but there is diversification benefit for investors to have exposure. And in the last 3 months, the euro has gone from virtually parity to the US dollar up to $1.15. So even without me and the team doing anything, there's 15% benefits to Singapore dollar investors. So diversification is really important. And from our perspective, we see, and we saw it 7 years ago, the rise of the financial services market here. So insurance products are only emerging throughout Asia. We know that the insurance market and the 401k market and the pension fund market in Europe is quite mature. It's deep, it's big, it's fragmented, but it's relatively mature. Whereas being here, it's exciting. We can have great relationships with our investors, and as their wealth increases, hopefully they want to increase more of their exposure with us. Over the longer term, as they get more comfortable with Stoneweg, you may possibly see more other Stoneweg branded initiatives here in Asia. So, I know, I'm now speaking on behalf of Stoneweg, not on behalf of the REIT, but you've seen public comments from Stoneweg. They see this investment primarily, firstly, as a value investment, but secondly, as a beachhead into Asia. So, the branding behind us of Stoneweg is quite new for investors here, but over the next few years, I would expect, hopefully, more investors to be aware of Stoneweg and therefore the opportunities that they can also bring, not just through other listed products, but potentially for high net worth family offices, more opportunities to invest in Europe. We've also seen, 13 or 14 Singapore REITs move into Europe. So we know that it's not just us or the other 2 dedicated European REITs here. We know that the big Singapore REITs are moving into Europe and have moved into Europe, some of them more successfully than others. Again, I say our point of difference is 200 staff on the ground in each of the cities that we invest. We don't make the investment decisions here in Singapore. If Cushman or JLL come around with a glossy brochure, it's too late. Those in the know have already said no to the deal. So, getting those insights every Tuesday on our pipeline meeting with what we call our truffle hunters in each of the markets, they know who's desperate to sell. Of the 57 buildings that we've acquired since listing, all but 1 has been off market. But we haven't had to participate in auctions. And this is the value that we can bring to the table that perhaps those coming in from that aren't deep rooted or deep based in these local markets. Often they don't get to see these nuggets of opportunity.
Well, thank you. So I think we've run out of time and come to the end of the session. On behalf of the audience and SIAS members, I would like to thank Simon for taking the time to engage us in today's dialogue. I apologize if I couldn't get to all your questions, but should you have further questions, please reach out to the Investor Relations or Stoneweg European REIT, and I'm very sure the teams will be happy to assist you.